So let's talk now about the super stock option strategy. And what we like to do is we trade both stocks and options when we use the major trend system. So if a stock is on a major trend system buy signal, then we'll go ahead and buy call options on it. And we use the Keltner channels, which I'll show you here in a minute, to select a low-risk entry point. So the super stock options strategy focuses on these super stocks, and we're simply buying call options on these super stocks, which are leveraged and have more return potential. So we trade both stocks and options on the super stock. So we'll buy a call option if the stock is on a major trend buy signal, and we'll use the Keltner channels to select a low-risk entry point for our option, and then we use what we call the 1% rule to select the option strike price. So again, we use the major trend system to identify super stocks with consistent and predictable price patterns and steady price increases over the past 20 years, low volatility, and they outperform the major stock market indexes, and we will buy call options on these super stocks. So options are what is known as derivatives, and they derive their value from the price movement of the underlying stock. So we use the major trend system to identify stocks moving up in price and that have a long history of price increases. So this allows us, when we buy a call option, this allows us to profit from the leverage that's available with options. And then once we decide to buy a call option on a super stock, then we use the Keltner channels to identify a low-risk entry point. And the Keltner channels are simply an overbought, oversold indicator. They're very similar to the Bollinger Bands. And when the price of the stock is trading up near the upper channel, this is a daily price chart from of Home Depot, and then we have the three Keltner channels on this price chart. We have the upper channel, the middle channel, which is this dotted line, and then the lower channel. So the Keltner channels act as an overbought, oversold indicator. When the price of the stock is up near this upper channel, or it's above the upper channel, then the stock is overbought, and it will usually retrace. So we can see that Home Depot follows this pattern. It got overbought here because it's actually above the upper channel, sells off, overbought, sells off, overbought, sells off, overbought, sells off. So we want to avoid buying our call option or our stock when the stock is overbought and it's trading up near this upper channel. And we'll just simply wait till it trades near the middle channel or the lower channel before we take our entry. And this usually works out for us in getting a low-risk entry. So we want to wait until the price movement is in this trading near the middle or the lower channel before we make our entry. So, and we don't want to buy when it's overbought, trading up near the upper channel. And the Keltner channels, of course, they use daily price movement for the Keltner channel. So this is a shorter term, and we know that the stock's already in a major trend buy signal, so what we're simply trying to do is select an entry point for a stock that's already moved up substantially and hopefully get a lower risk entry point. And we just use the standard parameters. You can download these for free on stockcharts.com, and we just use the standard parameters of 20, 2.0, and 10. And if you just click the chart for this, it'll show the daily price pattern along with the three Keltner channels. So let's look at some actual examples of trades we took, option trades that we took on super stocks. And this first example we'll look at was for Starbucks, and we looked at this just a minute ago, and we can see Starbucks in a very strong price uptrend, and it stayed above the 20-month EMA here since 2009. So a long price increase. So the question is, where do you want to jump into the stock if you want to enter it for the first time? And so that's why we use these Keltner channels, because they allow us to enter a trade that's been on a buy signal for a long time. So here's a daily price chart of Starbucks and with the Keltner channels, and we can see, it's already made a big price movement. So the question is, where do you jump in? So right here, we can see the Keltner channels drop, or the price of the stock dropped down to this middle Keltner channel, and so we bought Starbucks, the 40 strike call option at $13.75. So we actually added to our position. We already had Starbucks, but we added to our position right here when the stock dropped to the middle channel, and you can see the stock went up after our entry, so we got a low risk entry off of that. Here's another example of an option that we purchased recently. This is for the utilities ETF. Here's the long-term monthly price chart of the utilities ETF, and we waited until it dropped down towards this middle channel, and that was on March 2nd. So right in here, it dropped down towards that middle channel, so we went and bought the utilities ETF 40 strike call at 6.30. So this has about a 33% return so far, and we bought this on March 2nd. So here's another example, consumer staples ETF, and you can see on a long-term buy signal here according to the major trend system, and the consumer staples ETF went on a buy signal back here in mid-2009 and has had very steady price increases since then. So we wanted to add to our position, so we waited for a pullback here and bought the 45 strike call at 6.50. So these are just examples of how to use the Keltner channels to find an entry point on a stock or an ETF that's already been in a price uptrend for a while, and you simply want to participate and you want to enter and get a lower risk entry. So these are examples of using the Keltner channels to get a low risk entry because the stocks did not retrace much from our entry point. So this, when we use these Keltner channels, it helps prevent getting stopped out of our option position. So let's see here, super stock trading profits. These are just stocks that we've traded for a long time, and we've had substantial profits on these. These are just trades that we've owned for a long time. Home Depot, the NASDAQ 100 index. You can see the NASDAQ 100 index actually went long in mid-2009. It's been on a buy signal ever since. So this has been one that we've traded for a long time, and it's really a good stock to trade because you're participating in a high growth sector. But if you buy the index, you can see it's not as volatile as buying individual stocks. So this is a way to participate in these NASDAQ stocks without taking on a lot of risk. So this has been a great index for us. Okay, let's talk about what we call the 1% rule for selecting an option strike price. And whenever you decide that you're going to buy a call option, you could have hundreds or even thousands of strike prices to choose from. So the question is, which strike price do you select when you're going to take an option trade. So we use a very simple rule of thumb. We call it the 1% rule. And if you remember in option basics, option premiums consist of time value and intrinsic value. So every option premium has a time value component and an intrinsic value. And the thing you have to remember about options is options lose all their time value at option expiration. So when you buy a call option, you're buying a decaying asset. So you always have to keep that in mind when you're trading options, because that time value portion of the option is going to go to zero at expiration. So you always want to keep that in mind. So due to the time decay characteristics of options, when we buy an option, we want to minimize the time value and maximize the intrinsic value, because this time value, again, is going to go to zero at expiration. So the way we do that is we limit the time value portion of the option to less than 1% of the stock price. So if you limit that time value portion to less than 1% of the stock price, then the stock only has to go up 1% for your option to break even and start making money. So this is very important when you're trading options. So let's look at an example. This is that Starbucks example that I showed you a few minutes ago. We bought Starbucks retraced to that middle Keltner channel. We added to our position. So we bought the Starbucks 40 strike call at 13.75. And at the time we bought the call, Starbucks stock was trading at 53.63. So this would have been an in-the-money call, as the strike price was below the stock price. So this is an example of an in-the-money strike on that call option. And let's take a look at the time value portion of this option. So again, we bought the 40 strike call at 13.75. and Starbucks stock was trading at 53.63. So if you take the stock price of 53.63 and you subtract the call strike price of 40, you get an intrinsic value for this option of 13.63. So we paid 13.75 for the option, and it had an intrinsic value of 13.63. So if we subtract that intrinsic value from the premium that we paid, you can see we only had 12 cents of time value. So what that means is Starbucks stock only had to go up 12 cents, and this option is going to start making money. So we like to, whenever we trade options, we like to purchase strike prices that will start producing profits for that option if the stock only goes up 1%. So this is we have 6 different types of option calculators for our various strategies. And this particular calculator is for the call option purchase. And what this does is it calculates the profit potential for this option trade for buying the 40 strike call at 13.75. It'll calculate the profit potential assuming various price changes in Starbucks stock at option expiration. In this example, from a 30% increase in the price to a 5% decrease in the price. So the bottom row here gives you the percent return for the option based on the price movement of the stock. And the second from the bottom row here gives you the dollar profit or loss based on this price movement of the underlying stock. So we can see if Starbucks stock is flat at option expiration, this will lose 0.9%, so just under 1%. So that's a lot better than buying a out-of-the-money call or an at-the-money call, and if the stock is flat at option expiration, you could lose 100% of your premium. So we want to avoid that, so we buy these in-the-money call options that are less leveraged but also have a lot less risk. But you can see if Starbucks stock was trading at was up 10% to 58.99, then we'd have a 38% return for this option. So the stock is trading around 59 now. So we have about 38% return on this option. And if the option, or if the underlying stock, if Starbucks stock was up 20% at option expiration, this option would have a 77% return. So even though we're giving up some of the profit potential by buying an in-the-money call, you can see if the stock's up 10%, we get a 38% return. If the stock's up 20%, we get a 77% return. But if the stock is down, is flat or down slightly, we don't get wiped out like you would with an out-of-the-money or at-the-money call where you'd lose 100% of your premium. So it's a trade-off, but we like to trade with that 1% rule because we'll have a much higher chance of being successful with our option trading. So again, with the Starbucks option, the stock only has to increase 12 cents or 0.2%, and the trade breaks even, and then we start making money on the option.